one of our topics is about the creation of money out of nothing. And a lot of people, when they first hear that, including me, can't believe it because it sounds wrong, it sounds impossible, right? And so I'm going to very briefly discuss that and how that's been kind of proved in a way that is as close to conclusive, I think, as you can get. And it's extremely important. If banks are creating money out of nothing, then as Professor of Economics Richard Werner of University of Southampton in England has pointed out, then the very system for trying to regulate banks is deeply flawed. It's based on capital reserves, and if the Fed and the Bank for International Settlement set standards that as long as you make loans that don't exceed a certain amount of basic capital, like 10%, then we're going to have control over lending and we won't overheat the economy. Well, what that doesn't take into account is that banks create money out of nothing, and they can expand well beyond this 10% because the amount of money keeps increasing. So the current system of trying to prevent hyperinflation or a crash doesn't work. In addition, if we have a system where banks can create money out of nothing and they're creating 95% of our money, it means that all of our money is going to increasingly to a narrower and narrower sector of our economy, which explains all this austerity and decreased wealth and disappearance of the middle class. So what are the ways that we have of proving that money is created out of nothing? The first is just the authorities, as Ellen cited, the Bank of England in 2014 in their quarterly bulletin, former Secretary of the Treasury under Eisenhower, Robert Anderson, and other major banks, including the Fed, although it's not that well publicized. They've all said that. A second way is how accounting is done, and Richard Werner has written an article that really describes for the first time exactly how banks create money out of nothing and why other lending agencies can't do that. And that's because banks, under banking rules, are allowed to commingle their money with their depositors. Other lenders can't do that. And so when they make a loan, they have to actually take money out of their account and use that money to make the loan. But a bank, under accounting principles that are accepted, can mark that loan as a new asset, and then they become entitled to all of the interest on an asset that they created with the click of a mouse. A rather good return on effort, right? The third way is that Richard Werner did the first ever empirical study of whether a bank creates money out of nothing. He was able to convince a bank in Germany to do the experiment. And he took out a loan for himself of 200 euros in this German bank. And he videotaped the actions of the bankers involved in it. It was just a few people involved in this transaction. And he saw that they did not check to see if they have the money in the bank. They didn't have to do that. And he also took photographs of their accounting and what happened to that. And then he looked at the bookkeeping before and after. And of course, they had many other transactions in this bank that day. So it took a little time to kind of isolate this transaction. But sure enough, he showed there was 200 euros in new assets for this bank that were not there before. And then a couple years later, he did another empirical study. This time, he made it even more definitive. At the end of the year, after the accounting's all done for the year, and sometimes banks have to make a correction, right? Or they left out a transaction. Well, that's what he did. He took this transaction, the 200 euros that he borrowed, and he added just that transaction separately to the bank's accounting for the year. And that's an accepted procedure where a correction is needed. And sure enough, the only change in assets was this 200 euro increase in assets. Never done before, an empirical study of how banks create money. And believe it or not, some bankers don't know this. I actually had a conversation with the CEO of a bank with $200 million in loans. He does not believe that banks create money out of nothing. And as a result, partly of that, he doesn't see much promise for public banks. Okay?